One of the most confusing areas of business valuation is the question of what is the seller's discretionary earnings. I mean, this comes up again and again in the context of business valuation. A seller's discretionary earnings is the gross revenue, all the money your business brings in, all that money, and then you subtract all the expenses that you're claiming for tax purposes. Every expense you give your accountant for tax purposes to come up with a net income, that's your net income, and that's what you're going to have on a tax return. If you're a corporation, for instance, your salary's probably in there somewhere. So you've made a salary, and there's interest expense, and there's depreciation, and there's personal auto, and there may be everything that you ever purchased at Costco that ends up as an expense on that business. All of these things need to come back to arrive at seller's discretionary earnings. Generally, those valuations are a multiple of that seller's discretionary earnings, and that varies between 2 times, total earnings on up to 4 and maybe sometimes 5 times total earnings, depending on the kind of business and the amount of cash flow that's there. So the lender's going to start with the tax return, but the lender is also going to want to arrive at what the true seller discretionary earnings is. And they're going to do that by adding back depreciation, adding back interest, adding back personal medical, personal auto, these kinds of personal expenses that aren't truly business-related expenses, that cash will be available to the buyer. The lender wants to be sure that they're paid back. And the only way they're going to get paid back is from the cash flow of the business. Therefore, they're looking at seller's discretionary earnings the same as the buyers are. Good books, good bookkeeping, good tax returns, all of these things are going to increase the value of your business. You want to increase the value of your business? Keep good books.